Good morning, everyone. Welcome to our Andersen webinar. Today, Kathy and I are going to present the topic on tax for U.S. citizens resident in Canada. So before we started the webinar, we just want to go over some of the housekeeping items. So during the presentation, if you have any question, feel free to ask it in our chat functions. Gina and Evan from our office will be the panelists collecting some of the questions, and then they will answer some of the question during the webinar. For those one that hasn't been answered yet, they are going to bring it to us after we have finished the presentations. And then after the webinar today, you will receive a survey from us asking how we can improve, and then other topic that you might be interested in. Also, you could turn on the live transcript, the CC button on the bottom of the Zoom meeting to have a live closed captioning of the presentation. So today, our agenda is going to be talking about the tax based on the US citizenship, how to avoid double taxation, and then some of the common seen US and Canadian international tax forms, and also the filing options for taxpayers that have any delinquent US tax returns. So first, we're going to have Kathy to talk about some of the difference between Canada and US taxations.
Thank you so much, Philip. So Canada versus US, the two countries sound very similar and we're right next to each other, but there are quite a number of important tax differences that a taxpayer would need to watch out for. So getting right into things, I'm just going to go over things in general terms. Every taxpayer situation is very different. And so these are just generalizing certain information and at a high level, just to get an understanding, but for specific tax advice, definitely go to a tax professional for it. So in general terms, residency versus citizenship is really important, and most countries like Canada only tax a taxpayer on worldwide income based on residency. So if someone lives in Canada, it would make sense for them to be taxed on their worldwide income. And if they move out, they're only taxed on things that are sourced to that country. So generally, once you leave a country, you don't have to worry about having to report all your income on that country's tax return. But the US is a very different story. In the US, they base their income tax on citizenship. And this includes both US citizens and green card holders, where they will tax a citizen or green card holder on their worldwide income, no matter where they live in the world. So even if they move out of the US, they will still need to report their worldwide income on the US income tax return every year. So this really affects US citizens who are living in Canada, because now they're actually dealing with reporting worldwide income on both countries. Right, so the next thing I'll talk about is taxable versus non-taxable income. There's quite a few instances where something is taxable in one country but not the other. And a few that we see commonly are the tax-free savings account for one. The tax-free savings account in Canada, and it is a Canadian term, is where income is earned in the account, but is not taxable when earned. So any growth in that account is actually not taxable under Canadian law. However, the US doesn't actually recognize this account. And so even if a taxpayer is holding it and earning income tax-free in Canada, they actually need to report the income in the US and it will be taxable. So in the two countries, the tax effect is very different. Another common item that we have is principal residence. Canada has a very favorable rule where principal residence generally is not taxable when sold, even at a capital gain. And so if a taxpayer lived in that home for the entire period that they purchased it and sold it, they would not have any tax due. But on the US side, even though there is a principal residence exemption, it is not 100% like Canada could be. One other common one that I'll cover would just be the capital dividends. When a shareholder gets paid out capital dividends in Canada, it is completely tax-free, but on the US side, there is no such thing, and so it would be treated as regular dividends and taxed as such. Okay.
So Kathy, so it seems like there are a few different examples that is taxable in one country while it's not taxable in the other country. I think we just try to bring that to the attention to the audience that a lot of the time, Canadian and US taxation are really similar, but the difference is really that matters. So even certain income is taxable in one country, it may not necessarily taxable in the other country.
That's right. And it's always a problem when the two countries have a mismatch of what's taxable and what's not. And that's where having a professional take a look at the situation is very important here. Next, I'll talk about the due dates and extensions. So the due dates, of course, are very different. Canada, the tax returns are due on the last day of April. So this year is actually May 1st due to the weekend. On the US side, it would be the 15th of April, and this year is April 17th due to a weekend as well. But the most interesting issue is that the concept of extensions, which Canada doesn't have any of, but in the US side, there are such things as extensions, and an individual can file an extension to file their taxes in October 15th instead of in April. And this gives a taxpayer, especially one living outside of the US, a lot more time to gather their tax information and file a accurate tax return. For taxpayers who are living outside of the US, there's actually an automatic 2-month extension as well that the IRS grants. So then tax returns will be due in June. And furthermore, if certain qualifications are met, there's also a discretionary additional 2 months after extension. So this would mean December 15th, but certain requirements need to be met, and the IRS may or may not grant this one.
So Kathy, so for a US taxpayer, do they also get extension for tax payment as well?
So good question, Philip. Tax payment is actually not extended. So these extensions are only for the due dates to file the tax returns, but the payments themselves still need to be paid on April 15th. Okay. So U.S. gift and estate tax. Now, this is an interesting term that we actually don't see in Canada. Philip, do you mind going over what that really is?
For sure, Kathy. So in the US, when a taxpayer gifted money or when they pass away, they would be subject to a gift and estate tax instead of the income tax. So currently, every US citizen or domicile, they would qualify for a lifetime exemption up to about $13 million that has been adjusted for inflation every year. In contrast, in Canada, they have other way of catching those gift and estate. In Canada, whenever you make a gift, depending who you gift it to, there may be deemed disposition at the gift. There may be income attribution for the income generated from the gift. In terms of an estate, in Canada, instead of taxing the fair market value of the estate, rather the deceased would be deemed to dispose of most of his asset at fair market value on the day. So Canada only would tax the accrual gain on those assets instead of the fair market value of the whole estate. So you could see there was some difference in terms of how Canada and US try to tax the gift and estate of a person.
Mm-hmm. That's very true. Thank you so much, Philip.
Yeah, so since Kathy mentioned about that US citizen living in Canada would be subject to taxation in both countries. So the first topic most people would have then, am I going to subject to double tax, and how are we going to avoid double tax? So Kathy, can you share some of the idea?
For sure. Thank you so much. So US and Canada under domestic law and the income tax treaty both aim to avoid this double taxation issue. They do provide a series of rules to avoid double taxation, but it doesn't cover 100% of all the possible situations. So this is also a situation where it's great to talk to a tax advisor just to make sure that you're not getting double taxed when you're filing returns in both countries. I will quickly go over some of the income sourcing, and these are, once again, very general, as certain situations may result in different sourcing. But in general, you need to look at sourcing to determine who gets the first right to tax. And I'll go over the wages first. So for wages, these are generally sourced to where the taxpayer does the work. So now with the whole work from home situation, a lot of taxpayers are not working where they normally are or where the office is. And so a taxpayer would need to keep track of where they're doing the work and how many days in the year they're spending at that location, because the salaries that they get are actually sourced to the country they're physically sitting at. The dividends and interests are actually based on the location of the payer. Taxable capital gains are generally where the recipient is, or where the taxpayer is located. However, it does not apply to real estate, so real property. Real property gains would be sourced to where the real property is located. Okay. So next I'll talk about US exclusions and foreign tax credits. So these are the two methods that US tax has to reduce or eliminate double taxation. In certain situations, double tax is completely eliminated. In certain other situations, it may not be completely eliminated. So first I'll talk about the foreign earned income exclusion. So in 2022, the amount is $112,000 per spouse. And this is only deducted against earned income. So usually this will mean a non-US salary. The exclusion amount does increase each year for inflation, so the amounts would differ year by year. The foreign tax credit is a non-US tax that is a credit to a US return, and this is for foreign tax, so non-US taxes paid or a liability from a different country on the tax return, and usually it is a dollar for dollar credit. So Philip, do you mind quickly explaining what baskets mean here for foreign tax credit purposes?
For sure, Kathy. So the US foreign tax credit system, they kind of allocated income into different baskets. You could think about it as they categorize the income into different categories, and then they calculated how much US tax payable for the total income for that specific basket. Then they compare it to how much foreign tax that the taxpayer pay, and then they take the lesser of two amount. Some of the common basket, including passive basket and general basket, and also we have a new basket that they're going to applicable after the tax reform in 2018 is foreign branch income. So the passive basket would include interest, dividend, anything that is rather passive, or capital gain from selling your publicly traded stocks. And then foreign branch income is rather a new basket. It includes income that you earn from a foreign branch, which we will discuss in a later slides. Some of the common example, including self-employment income, business income that the taxpayer carry on outside of the US, potentially some rental income as well, depending whether they're passive or not. And then for the general income, it's just really anything else that hasn't been allocated to hasn't been allocated to other basket yet. So due to the fact that they only calculated the foreign tax credit on a basket basis, sometimes that a taxpayer or US citizen living in Canada, they would expect that they have paid enough Canadian tax, which is typically higher than US tax. they would expect that the foreign tax credit would be enough to offset all the US tax. But this scenario might not always be true because even though in general, the Canadian tax rate is higher, but sometimes in Canada, the COA does provide additional credit on certain passive income, for example, on dividend. The taxpayer would get dividend tax credit on capital gain. Only half of the capital gain is taxable. So sometimes the tax paid on maybe the passive basket would be lower than the US tax otherwise payable, resulting that the US citizen would end up owing some US tax even after claiming the foreign tax credit. So the key is really try to allocate those income and tax appropriately, and then get an understanding on the effective rate on each basket of income. And also because Kathy also mentioned that some income could be taxable in the US while not taxable in Canada. So when a taxpayer have significant TFSA investment income, it could create a US tax liability for such taxpayer. Mm-hmm. So that's why the basket concept is kind of important. The next concept is pay versus accrual. So by default, the US would use the pay method for foreign tax credit calculation. Essentially, it just try to track the cash transaction happen within the tax year. So if you use pay method for your 2022 tax return, they only care about all the tax payment that you actually make in 2022. Because in Canada, everyone should understand that we are typically there was tax withheld, and then between now and April, people would file tax return and make any payment or get any tax refund. So the tax payment may not necessarily reflecting the true tax liability of the income that they make in 2022. So that's why the taxpayer should consider using accrual method. That the accrual method is they only track the tax liability that is related to the income that is taxable in 2022. So any tax refund that you receive in 2023 after filing the return, those would not be able to claim as a foreign tax credit. It usually matches the income much better than the pay method. And once the taxpayer elected to use the accrual method for foreign tax credit, they could not go back to the pay method. But because of Canadian tax system, usually that gives you the better result, the better timing of matching the tax payment. And then the last point is the treaty credit for US citizens. So in Canada, they also have all kinds of rules regarding how much foreign tax credit a taxpayer could claim. In the case of a US citizen having US source, let's say pension income or dividend, Canada actually imposed some limitation on how much foreign tax credit that taxpayer could claim, resulting that the taxpayer could be potentially double taxed because they pay a higher US tax rate due to their citizenship. That's when the income tax treaty, there was a special article to provide additional credit for those US citizens to potentially resource a portion of those US pension income and US dividend income. One item to remember is those credit is only available for US citizens. So if you are a US green card holder or you are just living in the US, those credit would not be available to you.
Right. Thank you so much, Philip. And as Philip did mention, because Canadian tax is generally higher, Canadian tax rates are generally higher. We're like about in BC, it's about 54% at the top marginal tax rate, versus in the US, the top rate for federal is 37%. And we're excluding the state taxes here because this is only considering US citizens living in Canada, not in the state. Then in this case, foreign tax credits is generally always better to be used in comparison to foreign earned income exclusion, just because Canadian tax rates are higher. So usually, if it fully offsets the non-US income on the US tax return, of course, aside from the situations where Philip did mention, where the odd situation that the foreign tax credits don't cover it. Another benefit of using foreign tax credit over the foreign earned income exclusion is that foreign tax credits can get a carryover on the US return for up to 10 years. So even if the current year it's not going to be used, it can be used in a future year against non-US income. Okay, the foreign earned income exclusion, though, can be beneficial if the foreign tax is lower than the US. However, once a taxpayer elects out of the foreign earned income exclusion, they can't actually elect back in for 5 years. And there's certain facts also that a person needs to qualify for to get the foreign earned income exclusion, right, Philip?
Yeah, so the two tests is the taxpayer have to either meet the bona fide residence test. So you could think about it, the bona fide residence test is the taxpayer is truly living outside of the US. So they look at the home, what kind of term you're living in those countries. And then the next test is the physical presence test. The taxpayer have to be outside of the US for 330 days during the year to qualify. So even though the foreign earned income exclusion could be a simple solution that could be helpful for some taxpayer, we would still want to make sure that they would qualify for those tests first, that they would qualify for foreign earned income exclusion. If not, they could always use the foreign tax credit regime. Given that US citizens living in Canada, they most likely not going to owe any tax under the foreign tax credit method as well. And also for all the other benefit mentioned by Kathy, that's why we typically recommend using a foreign tax credit instead of foreign earned income exclusions.
Perfect. So next, Philip's going to talk about U.S. international tax forms.
Okay, so we have mostly talking about income tax that would just have direct impact on how much tax you owe to Canada or U.S. And at the same time, U.S. does have a lot of international tax forms that require informational disclosure. Those forms may not directly impacting your tax liability, but they do require a lot of information regarding all kinds of non-US, either account, trust, or entity that you own. Most of the time that we see those forms does carry a significant amount of penalty. That's why it's really the top of the really important items that we always advise our client. Even you don't owe any tax, you make sure you review all the holdings that you have, make sure you fulfill all the international tax requirements. So some of the common ones have in one of the US Treasury forms, FinCEN 114, we typically refer it as the Foreign Bank Account Report, FBAR. It just requires the taxpayer to disclose the maximum balance of all the non-US financial accounts, as long as the aggregated highest balance is over $10,000 US, is rather a low threshold. The current penalty on the FBAR is about $15,000. It was originally set up as a $10,000 penalty per form per year, which is adjusted for inflation. So right now it's 15. So as you can imagine, for the next couple of years when inflation is high, the penalty would be way more significant. And then there was also the other IRS form that is going to be fileable with the IRS. The 3520, 3520A are mostly related to a non-US trust, which we will discuss later. And then the 5471 is related to a controlled foreign corporation. 8621 is passive foreign investment company. Both of those topics we have been covered in an earlier webinar. So for those that are interested or you have any interest in a non-US corporation, feel free to check out those webinars. For 8850A is a disclosure required for non-US disregarded entity, which we will discuss in a later slide as well. And then 8865 is non-US partnership. It does have, so if the taxpayer owns a significant amount of interest on any non-US partnership, then they would have to file this form to disclose their interest and certain financial informations. And the form 8930A, non-US financial asset, it requires mostly similar information as the FBAR with some difference. The filing threshold is also different. So those are the common forms that we see on a regular basis. And I'm going to discuss a little bit further on what a non-US trust is. So the first thing we always have to think through is really what exactly is a trust for US tax purpose. So something that it would call itself a trust may not necessarily treat it as a trust for US purpose. So Kathy, do you have some example that that is called a trust but really not treated as a trust for US tax?
Well, there's a couple items that are common questions from our clients. One of them would be a tax-free savings account or a registered education savings plan or even a mutual fund. Are those trusts for US tax purposes?
Yeah, so for the tax-free saving account, our firm's filing position or determined basically is for TFSA, the owner of the account is acting on behalf of themselves. So they basically being the settler, the contributor, the beneficiary, the trustee of themselves. So we don't believe there is a trust arrangement set up. You are really not going to be in trust for yourself. So we didn't treat it as a trust for US tax purpose. An IESP is a trust. So the parents contributing asset to the plan, acting as the trustee, mostly for the benefit of their children. However, IRS has issued a revenue procedure couple years ago saying that if the IESP follows, could potentially qualify for exemption of filing the 3520 and 3520A related to the US trust, non-US trust reporting requirement. And then mutual fund is the important, it's kind of the interesting one. So most mutual fund in Canada is organizing as a mutual fund trust. So people would question, so is it really a trust? But if you think about it, as the mutual fund is really carry on a business for investment. It's operating as similar to a corporation. So for US tax purpose, they only look at the substance over the forms. So a mutual fund trust is treated as an association that tax as a corporation. So that's why one of the reasons why that a Canadian mutual fund would be treated as a passive foreign investment company, a PFIC, because even though it's organized as trust, it's really operating as like a corporation. And then because it's a passive in nature, that it becomes it got caught by the PFIC rules. So the other concept is also the income tax versus estate tax. So for residency purpose, like income tax, they have different criteria versus estate tax purpose. Income tax, they mostly have two criteria to determine whether a trust is a US trust or not. So if any trust didn't meet those two tests, it would automatically become a non-US trust. So the first one is the control test, whether the trust is controlled by a US person. And then the next one is the court test. Court test is if any of US court could implement administrative power over the trust. So typically, if the trust was set up outside of the US court would not have the power. So most Canadian trusts that you've seen would not be a non-US trust, even it was controlled by a US person. Estate tax is slightly different. They look at majority of the asset of the estate, and then look at whether the estate was controlled by a US person. So they have a slightly difference in terms of how to determine the residency of the trust. So let's assume that the taxpayer does have a non-US trust. Then the IRS actually going to further break it down into two different type of subtrusts. It's called the granted trust and the non-granted trust. We could go over some of the concept about granted trust. Is you could think about it as the grantor is the one that contributing asset into the trust, but still maintain certain control, or they are still enjoying some of the benefit of the trust asset. So from a US perspective, like I said before, they really look at the substance over the forms. So if you contributed asset into a trust for yourself, so you're really still owning it, owning all the asset inside. So the grantor will be treated as the owner of all the trust asset. The grantor have to pick up all the income from all the trust asset, and also required to file the form 3520, 3520A. So there was a lot of implication. Whenever we come to the non-US trust, we will review the deed to make sure we come to the determination whether it's a granted versus non-granted trust. A non-granted trust, like the name suggests, is any trust that is not a granted trust. It does have other tax implication as well, mostly related to if there was any US beneficiary, they could be subject to any income anti-deferral rules that they might be add on additional tax depending on how much trust income was retained inside of it. And some of the common issue for Canadian trusts is they could be either having a US beneficiary, that the contributor to the trust may be a US person, or also maybe even the trustee could be a US person. So anytime our client that have a trust or have anything to do with a trust, we always want to get a better understanding on who's involved, being the settler, contributor, trustee, beneficiary, their residency, their citizenship, to make sure you get a bigger picture and better understanding on if the trust would be subject to any US exposures.
Right. And is it possible at all for a US person to hold any trust at all without triggering these US tax issues?
Yeah, there was always way for setting up a trust with a US person involved. I think the key is, in case any of our audience that happen to be a US person want to set up a trust, we would want to review the plan ahead of time before the trust is set up, make sure that they understand the implication, and then try to understand what they are trying to achieve, and then try to structure the trust accordingly. There are certain cases that we even purposely set up trust for US contributor being a granted trust to maximize the gift to the second generation. Sometimes we even purposely set up granted trust with non-US grantor for the benefit of US beneficiary. So there was all kinds of planning idea. I think the key here really is talk to the tax professional before any trust was set up, and then make sure that you get a better understanding on what the implication and how could you achieve your goal.
Right, for sure.
So the next slide, we're going to talk about the non-US disregarded entity and branch. So if you are an owner of a non-US disregarded entity and branch, then you have to file the Form 8858 and disclose the financial information.
Well, before you go any further, do you mind quickly explaining what disregarded means here?
So disregarded is rather straightforward, as the name suggested. For US purpose, they are basically disregarded. From a US tax perspective, they don't consider that entity a separate entity. Anything held by the entity is considered directly owned by the owner. Some common example, including a Canadian unlimited liability company. So if you being the sole shareholder of that unlimited liability company, you would be considered owning 100% of the asset inside of the corporation, and then any income would be subject to your personal taxation. So for non-US branch, it's really depending on all the facts and circumstance. You could think about it as a branch as a standalone kind of business that is outside of the US, that typically have their own set of financial information track. So some common example that I have mentioned before is the Canadian self-employment income. So imagine when you have your business income, professional income, you do track those business revenue and expense separately, right? And then at the time of filing a tax, or your accounting would just have a separate set of financials. And because it's operating outside of the US, that activity would be required to be disclosed on the Form 8858. So this requirement is rather new. They changed the rules a little bit after the tax reform in 2018. So nowadays, that even you only have self-employment income and rental income, your US disclosure requirement is rather cumbersome to disclose those two activities separately.
Right. Does this mean that all sole proprietorships in every single rental property actually needs to file a separate 8858 form?
Yeah, if you interpreted the rule, you kind of have to, because you're actually tracking the financials separately for each rental, right? You're not going to put everything together unless you are owning the whole, let's say, condo building, but usually it doesn't happen for our individual taxpayer. So each rental property or activity have to be filed its own foreign branch requirement forms, and then the same apply to self-employment income.
Right.
So with the US kind of international disclosure requirement, and Kathy actually going to tell us a little bit about the Canadian side.
Right. So when a Canadian has ties to the US, generally there may be other international disclosures that are required to be filed on the Canadian side as well. So I'll just quickly go over some of the common ones we see. The T1134, this is for filing for foreign affiliates. Now, foreign affiliates generally mean when a taxpayer is holding 10% or more of a non-US, non-Canadian corporation. Actually, though, so there's like other situations where a taxpayer, even if they hold less than the 10%, we may want to get a tax professional to look at the situation to see if they require to file this form. This form itself is very extensive. And actually, it's quite complex as CRA has increased its filing reporting requirements over these last couple of years. The penalty for failure to file this form is $2,500, and this form is due not with the tax return, but it's due no later than 10 months after the year end. Okay. The next one I'll talk about is the T1135. This one we see more commonly with our clients here, foreign income verification statement. So this is when a taxpayer is holding non-Canadian assets over $100,000. And this can be from a non-Canadian bank, certain real property, and even non-Canadian investments held within a Canadian brokerage would also count. The penalty for a failure to file this form is also $2,500, and this one is due with the tax return. The T1141 and T1142 relate to foreign trusts, and Philip can go into more details on this on his next slide.
Okay, yeah, I just want to make a general comment. As you can see that the Canadian international tax disclosure is rather similar to the US disclosure requirement. They want you to disclose everything, any corporation that you own, any financial asset that you own, and any transaction that you have with a foreign trust. So there was a lot of similarity here, except the CRA typically impose a much less penalty comparing to the IRS. As Kathy mentioned, the maximum penalty is only about $2,500, which is based on how many days the form was late. So it's only $25 per day. Versus the US, typically every form has a penalty starting from $10,000. Even you are 1 day late, you will be still subject to the full $10,000. And also, iOS has been a couple initiatives to focusing on some of the international informational disclosure form penalty assessments. Over the last few years, we could see that they automatically assessing penalty on some of the forms, 3520, and the other form for the corporation, the 5472, it becomes automatic now. So the risk is much higher on the US side.
Right.
But even the Canadian still significant amount of penalty, and it does require a lot of information. So since Kathy talked about foreign trust, now again, the question becomes, what is a foreign trust for Canadian purpose? For Canadian tax purpose, they look at the residency of a trust on two different ways. They first have to look at the factual residency. So a factual resident trust of Canada basically means the trust's center of mind and management is located in Canada. So someone may ask, so what is exactly the mind and management of a trust? So typically, the trustee, if it's carry on its trustee duty, then usually the trustee is kind of managing the trust, right? It's deciding what kind of asset to invest, and then how much income to be distributed to each beneficiary, etc. So usually the trustee or the majority of the trustee group will be the center of the mind management. So if you have a US trust, that happen to have all Canadian trustee, then that trust would be a factual resident of Canada. It depends on how the trust set up. Certain trusts have protectors, or the trustee is just following the instruction from the beneficiary. Then we would want to review all the facts. We want to get a true understanding on who's really making all these decisions. So if the center of the decision maker is in Canada, then they would be a factual resident of Canada. So for certain non-Canadian trusts, even though they are not a factual resident, they could still be caught by being a deemed resident trust of Canada. So the deemed resident trust rule is rather complex. It went through a few different revisions over the last 10, 15 years. The government is really active on updating this rule to catch any non-Canadian trust for the purpose of avoiding Canadian taxation. So that's why they try to reach out to catch more non-Canadian trusts. For a non-Canadian trust to be a deemed resident, they have to be having either a resident contributor or a resident beneficiary. A resident contributor basically means whoever contributed to that trust have been a Canadian resident or is currently a resident of Canada. And for a resident beneficiary, like the name suggests, it would be having the beneficiary resident living in Canada with a connected contributor. So those rules are rather complex. So I would just want here to just talk at a high level. Make sure that if you have any relationship with a non-Canadian trust, make sure you talk to your tax professional, disclose all those relationships, then we would able to collect all the information to make that determination. So one problem for non-Canadian trust is it could potentially happen a dual residency. What it means is when a trust is considered as a US trust under the US rules, but is also considered as a Canadian trust under the Canadian tax rules. So it happens a lot for individuals when taxpayer is either spending significant amount of time in Canada and also in US. They could be both a tax resident of both Canada and US. So in that case, the income tax treaty usually kicks in. There was an article talk about residency to help the taxpayer to determine which country he's really a resident of. So most cases, it would end up that the taxpayer would be only being a resident of one country at a time. However, that treaty was not so applicable to a trust. There was no language specifically about trust. So it's not too helpful in figuring out the residency of the trust. So it could happen being that, like I said, the trust being both resident of Canada and US, and then subject to taxation in both countries, resulting potentially for the same income being double taxed. That's when we try to get in, and hopefully we could solve the problem by changing certain agreement of the trust or changing some of the facts to get out of it. So with the non-Canadian trust discussion, Kathy is going to talk about the delinquent US tax filing returns. We see a lot of our client or US citizen out there that they probably didn't even spend any time living in the US. They never worked there. They probably happened to be born in the US and then come back to Canada at a young age, or they even get the US citizenship from their parents. They never filed a US return. So what's the option or the penalty exposure for those clients?
For sure. So the penalties for late filing and late payment isn't the most significant. It's calculated at up to 25% of unpaid taxes. But what's important here, and Philip did mention this, is the failure to file U.S. international tax forms. Now, these ones have more severe penalties, where the minimum is a $10,000 penalty and it goes up to $25,000 per form. So it could really add up, and it's really significant. But the good news is that the IRS does provide some relief here, especially for US persons living outside of the US. And these streamlined procedures generally may waive most, if not all, of the penalties if a taxpayer qualifies. And it does, IRS does do this to promote having US persons get caught up on their tax filing, which is great. Most commonly, we do see our clients file under the foreign streamlined offshore procedure. Now, this procedure allows a taxpayer to get all penalties waived. So the only thing that they'll need to pay upon filing is the interest on any tax liability, which is great. And all you need to do to get up to date with filing your tax returns is to file the last 3 years and also the last 6 years of FBARs. So as long as all the disclosures are in there with the 3-year return, it could really alleviate all the severe penalties that would have otherwise been incurred. But Philip, I know that there are some ways that taxpayer has to meet to qualify for these offshore procedures. Do you mind going over those?
Yeah, for sure, Kathy. So one of the key criteria is the taxpayer have to be non-willfully not compliant. So what it means is the taxpayer could be not aware of the filing obligations, so they are not willfully. What considered as willfully is if the taxpayer is clear about their filing obligation of the U.S. tax, but choose not to file it, that it becomes willful. It could, in that scenario, the taxpayer could no longer rely on the streamlined offshore procedures. Another criteria for the foreign streamlined offshore procedure specifically is the taxpayer have to be outside of the U.S. for at least 330 days in at least one of those 3 years that was covered. I think the IRS decide point is they really truly decided those procedures for taxpayer actually living in Canada, outside of the US. Mm-hmm. So if the taxpayer spent too much time, let's say over 35 days every year for the last few years in the US, there is still an option for the domestic streamlined offshore procedures. In comparison to the foreign ones, they are not as preferable because they do have a 5% penalty on any undisclosed non-US financial asset. Depending on the facts, it could be a viable option when the taxpayer has already previously filed all the FBAR forms disclosing all the financial asset, but forgot to maybe file another other international form that does have a significant amount of penalty. Then they could still qualify under the domestic streamline to file those delinquent international forms. Mm-hmm. And the next thing is called reasonable cause. So the reasonable cause, you could think about it as a reason that is strong enough to cause you not to file. Some of the example may including if you disclose all the information to a tax accountant that is qualified, but he tells you, oh, you don't have to file anything, then you potentially could rely on that being a reasonable cause. Or you happen to have physical or mental issue right at the due date of the return, that the IRS could potentially accept that reasonable cause and waive all the penalty for on any of the delinquent forms and tax returns. The final option is there was the delinquent international informational returns. Those would be, that program is designed for taxpayer that has filed a return, but forgot to file some of the international informational returns. If the taxpayer attached the reasonable cause along with these filings, IRS would have a chance to potentially waive the penalty. But because this program does not have a certainty level as high as the streamlined offshore procedure, we typically recommend our client, if they otherwise qualify, we would file those delinquent files under the streamlined offshore procedures. Mm-hmm. So this is our presentation today. So please feel free to ask any question if you have any. And then, like I said before, after the webinar today, you will receive a survey, tell us how we can improve, and then other topics that you would like us to cover in the future. So we will stay here for any question that we have collected. Our panelists, Gina and Efren, will ask our question. And thank you for attending.
So Philip and Kathy, we have some questions about RESP plan. So you have touched on the RESP plan briefly. Can you please confirm that it does not need to be reported on Form 3520? And if so, does the U.S. person still need to report and pay tax on the income in RESP?
Yeah, Gina, I can take on that question. As like I said before, the IRS issued a revenue procedure back in 2020 saying that certain tax preferred plan that's set up outside of the US could potentially being exempted from the 3520, 3520A filing requirement. If you read that revenue procedure, a lot of those criteria kind of, you could feel that the ISP could meet most of them, but again, depending on how the ISP set up, I believe there was the contribution limit could potentially be over. So there was no black and white answer on it. I have hear other practitioners saying that they want to still be on the safe side. They still file 3520A for IESP. Certain practitioner thinking that that's just going to exempt everyone. And other criteria for the exemption is the taxpayer have to be otherwise compliant with tax return first. So they could not relying on that for their, let's say the streamline, because they are delinquent, they never file a US tax return. And then to address the income question is, no matter whether you file the 3528 or not, the income inside of the IESP still goes back to the parents, presumably who is the one that set up the plan, who contributed the money. Because in that case, the IESP is still considered as a foreign grantor trust. The grantor will be still responsible picking up all the income and reporting all the asset. The exemption is really specifically regarding whether the IESP required to file a Form 3520A or not, which is depending on the practitioner's interpretation.
Thank you, Philip. And another question. I filed my US tax returns, but missed some information or forms you discussed today. Can I just file those forms, or should I amend the entire tax returns? What action should I take?
So as discussed before, when a taxpayer forgot to file international informational returns, we would still want to review the streamlined qualification to see whether the taxpayer qualifies. Let's assume that it does qualify, then we would still want to file an amended return with all the informational disclosure, all the informational returns. So to make sure that all the filing, all the delinquent filing was accepted under the program instead of just amending it. Because whenever you're amending a return by having delinquent international informational forms, you basically open up for the IRS to potentially review and audit the filing. They may assess the penalty because you were not originally file those forms on time. So we want to make sure that all the option was considered, whether there was qualification for streamline, whether there was a reasonable cost first. If there was yes, then we would try to find out other alternative to file those delinquent forms. If not, then the taxpayer could still take the chance to file those amended return with the forms, maybe potentially hoping the IRS would not assess the penalty.
Okay. One other question we have here. If my income is less than US taxable income threshold, do I still need to file a US tax return?
I think you will still review the reporting or the filing requirement. If your income is lower, likely you don't need to file the income tax return, the US income tax return. However, like we keep emphasizing during the presentation is you want to make sure that you are not required to file any international informational return as well. Because sometimes you could probably making minimal amount of income. But let's say if you do have a bank account sitting with $25,000 cash, then you would still file the foreign bank account report. And if you probably happen to be a shareholder of another foreign corporation, then you still want to file the return. So I think you want to review everything, make sure that you are not required to file anything before you choose not to act on it.
Thanks, Philip. And one more question. If I'm a US green card holder working in the US but living in Canada, what would be tax result if I sell my home in Canada?
So again, we would have to analyzing the residency first, right? So assuming all the facts was lined up that the taxpayer is a green card holder working the US but being a Canadian resident, then he would file both Canadian and US resident tax return. And then, like Kathy have mentioned, because now his worldwide income is subject to taxation in both countries, then we will have to determine the income sourcing of each type of income. So for the wage that for his work in the US, those would be US source income. It would be subject to US taxation first. And then Canada would provide a foreign tax credit. In terms of the disposition of the residency, it depending on the location. Let's assume it's based in Canada, then the gain would be exempted from Canadian taxation, assuming that he qualified for the principal residence exemption and have used it for the whole period of the time of the ownership period. And then on the US side, we would want to review whether the same principal residence capital gain exemption criteria was met. Then we calculate a gain because the taxpayer could exclude up to $250,000 of the gain. So if the gain is lower than that, he would not subject to tax in the US either. But if it's higher, then the excess portion will be taxable in the US.
Yeah, so the main idea is that the sale of the property is reported on both countries' tax returns, assuming that this person is a resident of Canada with a US green card. If the person is actually not a resident of Canada, things will be a little bit more tricky when you sell a Canadian real property as a non-resident. There will be other disclosures required and forms required to be filed as well there.
Okay, if we have a time for this one last question, if a dual resident in the sole trustee for an estate trust where the property resides in Canada, would this ever be considered a trust in the US as well as Canada?
So Gina, I probably have to clarify on your question. So it would be a dual resident. So I assume a US citizen living in Canada, being the sole trustee of an estate?
Yes.
And the estate holds Canadian real property?
It didn't say real property. The property resides in Canada. I would assume that it is a real property in Canada.
Okay. So there was some slightly difference for estate and trust for the US tax concept. So in Canada, an estate and trust is rather exchangeably, like they are pretty much the same. Other than the first few years that it could be a graduate rate estate that's subject to a graduated rate instead of the higher rate. I just have to go through my mind again. So the estate would be definitely subject to Canadian taxation if they was located in Canada, with the trustee also living in Canada. So it would be subject to Canadian taxation because the asset is in Canada, the my management is in Canada, so it would be a factual resident of Canada. Then we look at the US side, that for income tax purposes, they would have to look at two tests, right? The control test and the court test. So it is controlled by a US person, so it's controlling the US. And then the court test, depending where the estate was set up, where did it go through probate? I have to assume that the estate probably coming from a Canadian deceased. So likely the probate went through in Canada. Then the US likely would not have any administrative power over it. So for that case, that conclusion, because it didn't meet both tests, is a foreign trust for US purpose. And then the foreign trust, then we would need more facts to determine whether it's a grantor versus non-grantor trust, whether there was any U.S. beneficiary that is listed for the estate. By being the trustee of a foreign trust doesn't necessarily create any reporting requirements. You would have to look at whether there was any U.S. owner or U.S. beneficiary or any distribution to U.S. beneficiary first. So I think we would need more facts to come to the conclusion. So I think we are running out of time right now. So again, thank you for attending. We wish to see you in any future webinar. Thank you.
Thank you.